So we've purchased a plant asset. We've got it ready to use. We're using it to generate revenue. But all of that money, all of those costs that we laid out, when do we recognize those as an expense? When do we get to take them against revenue? That's the process of depreciation. Depreciation is a process allocating to expenses the cost of plant assets over their useful or their service lives in a rational and systematic manner. These cost allocations are designed to properly match expenses with revenues. Depreciation will impact the balance sheet through the accumulated depreciation account, which we'll talk about, which is reported as a deduction from the plant assets. It's a contra account. And it affects the income statement through the depreciation expense. Depreciation is a cost allocation process. It is not an asset valuation process. So the book value of your assets at any given point in time do not necessarily have any relationship at all with the fair value of the assets in the market. Depreciation applies to 3 classes of plant assets: land improvements, buildings, and equipments. It does not apply to land. Land is not a depreciable asset because it is not going to wear out. Depreciation recognizes that over the course of the life of an asset, its ability to produce revenue is going to decline because of wear and tear. A decline in the revenue producing ability may also occur because of obsolescence, the process by which an asset becomes out of date before it actually physically wears out. And we recognize depreciation for assets that do not result in the accumulation of cash for the replacement of the asset. Those two really do not have any relationship. The balance in the accumulated depreciation account is going to represent the total amount of the asset's cost that the company has charged to expenses to date. It is not a cash fund. Depreciation is simply a systematic way of allocating the cost of an asset over the course of its life. There's no attempt to bring the asset to fair value. Think about buildings that are very old and have been owned by a company or an individual for a very long time. The book value of those assets, cost less accumulated depreciation, is probably relatively small. But when we think of the market value, what those buildings would sell for today, they may not have depreciated at all. So their market value may not have fallen. In fact, it may have increased. So as you can see, there is no relationship between market value and book value. There are 3 factors in computing depreciation. The first is the cost. How much in expenditures was there, according to the historical cost principle, to acquire the asset and make it ready for use? What is the estimated productive life, also called the service life or the useful life of the asset? And at the end of the asset's life, what is the estimated asset's value? What is the salvage value that we can expect? Management is responsible for determining what they expect the useful life to be and what the salvage value would be. They will also choose the depreciation method. Some of the ways to estimate useful life would be based off miles driven, or it could be based off a historical perspective, could be based off engineering specs. There's a lot of different ways and things that management uses to determine the useful life of an acquired asset. They also use these same types of factors to determine, after we have used an asset for this period of time, what type of value would it have? Can we sell it to another company? Do we need to sell it for scrap? Is it going to have any value at all? Are we only going to be able to throw away the asset? What can happen at the end of the life? After we know what our cost is, our useful life is, and our salvage value, then we apply to that a depreciation method. Depreciation is generally computed using one of three methods. There are more, but these are the three most common: straight line, a declining balance method, or units of activity. Each of these is acceptable under generally accepted accounting principles. And once a method is chosen for an asset, it should be applied consistently over the useful life of that asset. You can choose a different method for a different asset. You do not have to use the same method for all of your assets. Management should select the method it believes to be the best measure of the asset's contribution to revenue over its useful life. Straight line method is the one most widely used, as you can see here, at an 83%. It is used for some or all of the depreciation by more than 95% of U.S. companies. So let's take a little bit closer look at how depreciation works. We're going to use Bill's Pizza, who purchased a delivery truck on January 1st, 2017. It had a cost of $13,000 and an expected salvage value of $1,000. This gives it a depreciable base, or an amount that is going to be cost allocated or depreciated, of $12,000 over the course of its useful life. Now, that useful life can be determined in either 5 years or 100,000 miles. We're going to do a computation of the depreciation using each of these methods: straight line, units of activity, and a declining balance, and talk about those methods as we move through them. So starting with straight line, the one that is most used, an equal amount of depreciation expense is recorded each year of the asset's useful life. To compute the annual depreciation expense under the straight line method, we divide that depreciable cost, or that depreciable base, of $12,000, cost less salvage value, by the asset's useful life. So $12,000 divided by 5 gives us a depreciation expense annually of $2,400. If an asset is purchased in the middle of a year, rather than, say, on January 1st, we would prorate the annual depreciation to the amount of the year that it was used. So let's look at an illustration of straight line. This is a depreciation schedule and what it would look like. So we have 12,000 multiplied by 20%. That is 100% divided by 5. That means that we will have a 20% annual expense of $2,400. In the first year, the accumulated depreciation account would have $2,400 posted to it, and the book value on the balance sheet of this particular asset would be $10,600. We would recognize depreciation expense of $2,400. and an accumulated depreciation of $2,400. Now, as time continued to move on, we would continue to have a 20% rate and an annual expense of $2,400. Our accumulated depreciation account would increase by $2,400 annually for this asset, and our book value of our asset would reduce by $2,400 every year. We continue to see that as we move through every year of this asset's life. And in the final year, you'll notice that the book value of the asset will drop to its salvage value. Now let's assume that this truck, instead of being bought in January, was purchased in April. In the first year of the asset's life, we have a partial year allocation. So instead of $2,400 of expense, we would only have $1,800. The last 3 months of that year would occur at the tail end of the life of the asset. We would only have $600. Now, while it seems like there's a whole lot of years here and there's a whole lot more than 5, really, in essence, we only have 5 years represented. This one is a full year, 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 for 4 full years. And then in 2017, we had 3/4 of a year, and in 2022, we had 1/4 of a year. The next method that we'll look at is the declining balance method. Declining balance method computes depreciation expenses using a constant rate applied to a declining book value. So now book value becomes a factor in determining what our depreciation will be for that year. This method is called an accelerated depreciation method because it results in more depreciation in the early years of an asset's life and less depreciation in the later years of an asset's life than does straight line depreciation. Declining balance approaches can be applied at different rates, which results in varying speeds of depreciation. And a common declining balance rate is double the straight line. This method is referred to as the double declining balance. The straight line annual rate of depreciation is computed by dividing 100% by the estimated life of the asset. For example, an asset with an estimated 5-year life, the annual rate is 100% divided by 5, which gives us 20%. And then we apply whatever the acceleration factor there is to that. We apply that rate to the book value as we move through the life of the asset. So let's look at how that would work. We have a beginning book value of $13,000 for this truck. We're using a declining balance rate of a double declining, so that is 20% multiplied by 2, so multiplied by 40%, giving us an annual expense in the first year of $5,200. We would post $5,200 to our accumulated depreciation and $5,200 to our depreciation expense. We'd have a new book value of $7,800. That book value of $7,800 is a factor in calculating year 2's depreciation expense. We multiply it by the declining balance rate of 40%, and we get $3,120 for year 2. We post that to the accumulated depreciation account, and we get a new book value of $4,680. $4,680 multiplied by 40% would give us a new annual expense of $1,872. Accumulated depreciation would increase by 1,872 to 10,192, resulting in a book value of 2,808. 2,808 multiplied by 40% gives us 1,123. That gives us accumulated depreciation of 11,315 and a book value of 1,685. 1,685 multiplied by 40% is actually 674. We will adjust that in the final year to bring our book value to the salvage value of 1,000. We have to plug our final years. At no point in time should your book value of your asset fall below that of your established salvage value. Now let's look at the partial year with the purchase on 4/1/2017. You see in the beginning, we multiplied it by 9, divided by 12. And the 3,900 less 3,000 gives us the book value of 9,100. Then we just continue in that same manner all the way through into the last year, in which we plug the amount that we need, because the annual expense would have been 472. We only need 180 to realize full depreciation of $12,000. This would leave us with a book value of $1,000 for this asset. Now, the third type of depreciation that we're talking about is the units of activity method. Under the units of activity method, the life of an asset is expressed in terms of the total units of production or the use expected from the assets. The units of activity method is suited to things like factory machinery and items like delivery equipment, airplanes. This method is typically not suitable for things like buildings or furniture because the activity levels associated with those are really difficult to measure. Under units of activity depreciation, the amount of depreciation is proportional to the activity that took place during that year. So to determine what that depreciation cost is, we take cost less salvage for depreciable cost. We divide it by the estimated total units of activity expected from that asset over its entire useful life to give us a cost per unit. We then apply the amount of that cost per unit to the units of activity that occurred during that specific year to determine what the depreciation expense is. So for units of activity method, it all comes down to what occurred in that specific year. That's how we calculate our depreciation expense and what we will post to our accumulated depreciation account. So we keep track of whatever that unit of activity is. There were 30,000 miles driven in 2018. At 12 cents a mile, our annual expense will be $3,600. 20,000 miles for 2019 gives us $2,400 in annual expense. And we continue this process through the useful life of the asset. Until we reach salvage value. Now you can see that the three different types of depreciation can yield a much different depreciation expense. Management needs to choose the appropriate depreciation expense for the asset because the total after the life of the asset will be the same, but how much is claimed in which year is going to be different. So as you can see here, over the course of a useful life, just graphically what the difference can be related to a type of depreciation or a method of depreciation chosen. GAAP requires that we use one of the systematic methods. However, in one of the many instances where GAAP and the Internal Revenue Service do not agree, is that the Internal Revenue Service does not require taxpayers to use the same depreciation method on their tax return. IRS allows corporate taxpayers to deduct depreciation expenses when computing their taxable income. But frequently it's not the same method that's used in preparing the financial statements. At the same time, they also require the use of special accelerated depreciation methods on tax returns. And for tax purposes, taxpayers must use their tax returns either a straight line method or the special accelerated method that applies only to income taxes called the Modified Accelerated Cost Recovery System, or MACRS. MACRS is not an acceptable method under GAAP, so there may be a difference between the depreciation expense that is taken in the financial reports and the depreciation expense that is allowable underneath income taxes. How this is handled is a little bit complicated and something that we cover in intermediate accounting too. Just so you know, we don't go into it in depth here. The choice of your depreciation method is going to be disclosed in the company's financial statements or related notes. And it may be a little bit more nebulous. So here, like they say, for flight equipment and for ground property equipment. And that there's ranging of 23 to 25, 5 to 30. But they're at least giving you a basic understanding of what it is. Periodically, management should review the annual depreciation expense. If wear and tear or obsolescence indicate that the annual depreciation is inadequate or excessive, the company should change the depreciation expense amount. When a change in the estimate is required, the change is made in the current and the future years, but not prior periods. Thus, when a change is made, there is no correction of previously recorded depreciation expenses. The depreciation expense for current and future years is revised. The rationale for this treatment is that the continual restatement of prior periods would adversely affect users' confidence in financial statements. Significant changes in estimates need to be disclosed in the financial statements, and this is not considered an error, it's just a change in the estimates. Extending an asset's estimated life reduces depreciation expense and increases current period's income. So let's look at how that might happen. Now remember, management is responsible for the estimates of useful life and salvage value. Useful life may change over the course of owning the asset. We may begin to use it less, so that useful life may actually be longer than initially anticipated. So Arcadia High School purchased equipment for $510,000. which was estimated to have a useful life of 10 years and a salvage value of $10,000. Remember, those are estimates. Depreciation has been recorded for 7 years on a straight line basis. In 2017, which is year 8, it's determined that the total estimated life should be 15 years, with a salvage value of $5,000 at the end of that time. Something occurred that made us realize that we will be able to use this asset for a longer period of time, and it's not going to be worth as much as we originally anticipated at the end of its life. What is the journal entry to record the prior year's depreciation? There is no entry to correct that. We don't go backwards. We use the current year forward. Now we're going to calculate the depreciation expense for 2017. We started with equipment cost of $510,000 and a salvage value of $10,000 for a depreciable base of $500,000 and an original life of 10 years. That gave us annual depreciation of $50,000 for the 7 years that we have already depreciated. That means that we have depreciated $350,000. What is the net book value on this date? So when we're going into 2017, we have a net book value of $160,000. This is what we're going to use to reevaluate depreciation expenses for 2017 forward. We have $160,000 net book value, and we now have a new salvage value of $5,000. This gives us a new depreciable base from today forward of $155,000 that will occur over the next 8 years. That gives us annual depreciation of $19,375. So recognize depreciation expense of $19,375, and we'll post to our accumulated depreciation $19,375. Now, sometimes we have what's called an impairment. Something has occurred that has resulted in a permanent decline in the fair value of the asset. In order that the asset is not overstated on the books, it's written down to its new fair value during the year in which a decline of this occurs. In the past, some companies delayed reporting losses on impairments until a year when the impact on the company's reports was minimized. This is called earnings management. As a result of earnings management, immediate recognition of these write-downs is now required. So let's look at revised depreciation one more time. We've got Chambers Corporation, who purchased a piece of equipment for $36,000. It estimated a 6-year life and a $6,000 salvage value. Using straight line depreciation, this was $5,000 per year. So $36,000 minus $6,000 divided by 6 is $5,000. At the end of year 3, but before the depreciation adjustment, it was estimated that the new total life was actually 10 years, and the new salvage value was $2,000. So we're asked to compute the revised depreciation. First, we have our original depreciation expenses of $5,000. We're at the end of year 3, but we haven't posted our depreciation. So we have only actually depreciated for 2 years. So we've taken $10,000 in accumulated depreciation against a piece of equipment that was $36,000. This gives us a net book value at that point of $26,000. If it's going to have a salvage value at the end of its life of $2,000, this is our revised salvage, that gives us a new depreciable cost of $24,000. If the new total life was to be 10 years and we have depreciated 2, that means that we have 8 years left and an annual depreciation of $3,000.